Let's get to your top ideas here, gentlemen, and either of you can pick up on this question. So we'll start with Dye & Durham. This company went public last year. You participated in the IPO. You've bought some more. It is a consolidator in the software legal space, and it made that big acquisition a while ago, buying Due Process for more than $500 million. So is this model sustainable for several years, do you think? And maybe, of course, explain the company a bit.
Dye & Durham does legal software in a whole bunch of different areas. So you can imagine the legal profession needs documents and software for one thing or another, and that's what Dye & Durham does. That in itself is an attractive vertical for anybody who's interested in investing in the software business. But I think what makes Dye & Durham really stand out is that tech investors right now tend to look for two things, and we mentioned this in the newsletter that you posted, right? In terms of that rule of 40, they're looking for high revenue growth, and they're looking for high let's say EBITDA margins, and some combination of the revenue growth and the margins that will get you to a number that's over 40, right? So if you have 20% revenue growth and 20% margins, you add them together, that's where you're at 40%. So 30-10 can work, 20-20 can work. Well, when you get to a company like Dye & Durham, that combined number is something like 80 or 90% because the margins are really high and the growth rate's really high. So and adding on to all that, its price to sales multiple is pretty reasonable right now. So Dye & Durham just looks like it's absolutely loaded to move forward. But as you know, Mark, the management team is pretty sharp and they're pretty growth oriented. So what they're able to do is take those cash flows from those really high margins, which are somewhere between 55 to 65%. That's a really high margin, right? You've got companies like Adobe that are 10% lower than that, and we think Adobe is one of the most profitable companies in the world. So when you combine the fact that the revenue growth is high and the margins are high and the valuation is reasonable, we can't help but think that this stock's going to go much, much higher.
Jesse, there's been some controversy about Dye & Durham recently because in the process of taking over Due Process, and apparently this is what they do on a regular basis, is they take a product that are used by legal people and then they raise the price. And in this one case, raising it by 400%, and there's a bit of outrage among lawyers. So is that a concern to you? Is it a problem from a PR standpoint? Are they going to change their ways at all, or is that just the course of how they do business?
It's definitely a problem, especially from a PR perspective. They probably went around the Due Process price increase incorrectly. We're still doing some work on our side in the sense of, how many customers will that impact, and the one thing to really watch, and the management team was straight up from the beginning in the sense of why a lot of these acquisitions work is because they are undercharging their customers. So it's like when Netflix raises your price from $9.99 to $12.99 to $15.99, you're kind of upset, but you're still paying it because you still think there's a ton of value there. Where they definitely went around this the wrong way, but when they're saving the law firm thousands and thousands of dollars per transaction, then it should be worth it. Anyways, that's they were pretty much upfront with this since the IPO, but this one in particular is probably a little touchy.
All right, another idea, gentlemen, is Wishpond. And Jason, this is one that you say, and Jesse's saying, that is right on that cusp of that threshold that you talked about, around 100 million. So digital marketing solutions, explain what they do.
Yeah, sure. So where we're finding a lot of value is in the small to mid market. So there's a lot of large software companies, especially in the States, that focus on enterprise. And where we're really focused is on the B2B, but in the small to medium size, because we do focus on these smaller companies. So that's what Wishpond does. And they really focus on being able to tie all the products someone will need to market and sell online into a single, cheap, usable platform. And talking about, why we kind of do well is we participated in size in that IPO at 75 cents. The stock's at $2 today, a couple months later, and it still looks cheap because they're doing some acquisitions along the way. They did 2 in December. They raised a bit of more money, and we think they'll do a larger one soon. So getting onto these early and seeing a lot of value in the B2B small mid-sized business, and that's exactly where these guys fit.
All right, and then Sangoma Technologies. This is a company that's been around for a while. It's gone from hardware to software. You think it can double in the next 3 years or so. Is the market underappreciating or not noticing that they've made this switch?
I think Sangoma's got a number of things going for it. And I mean, obviously, the stock is performing well. It has performed well for the last couple of years. I think that this is onto radar screens now, but there's still a big valuation discount. So I think the smart money has figured out that there was a change of management, there was a change of focus for the better starting around 2015. And that's starting to be reflected in the growth rates and the margins of the business. They're well cashed up. So there's probably a big acquisition in the future. The other point, though, that I've increasingly come of the view of, having looked at a lot of the U.S. Companies that are in a similar space, is Sangoma could be a very interesting acquisition. So I think Sangoma's there's a lot of room for Sangoma to move up from where we are right now. It's still, if we were starting a portfolio today with fresh money, that Sangoma would be at one of our top picks right today with fresh money, even though our average cost in this stock is much lower than where we are right now.